Hi everyone, welcome to the fifth module of Switch and Virtual in Finance and Economics. Today we're going to explore something that affects every day or every part of our lives, from the moment we earn our first paycheck to the way our governments function, which is finance and economics. These two fields can sound intimidating, but they are actually all about everyday choices. The choices we make with our wallets, our time, and even our careers. Let's continue further to the table of content. What we are going to discuss in chapters, I would say. It's finance and economics first, as definitions, continuing to the global economic trends and market analysis, then decision-making process and leadership, and the last one, management and finance of the EU programs. About the principles. So, why is it important to understand core issues about finance and economics? Some of the reasons would be due to the scarcity of economic resources, limited financial capabilities, budgetary planning, and that understanding also helps us improve economic and financial welfare. So, to ask you one question is that have you ever had to decide between saving money or going on vacation? Or maybe you have wondered why groceries are suddenly more expensive than last month. That's economics and finance in action. So these disciplines help us deal with scarcity, the idea that we have limited money, time, and resources, and we need to make smart choices. Understanding these tools helps us live better, plan smarter, and even sleep more peacefully at night, because we are not constantly stressed about money or the future. So, finance and economics. Economics and finance are interrelated disciplines that inform each other, even if the specifics are distinct. Finance as a discipline is derived from economics. It involves assessing money, banking, credit, investments, and other aspects of the financial system. Finance can be further broken into three related but separate categories, which are public finance, corporate finance, and personal finance. So, when we compare finance versus economics, we could say that think of economics as the big picture, which is it studies how countries, businesses, and people make choices when resources are limited. On the other hand, finance zooms into the money part of that picture, and it's about managing assets, as I said, budgeting, borrowing, saving, investing, and making sure that the number adds up. So, economics explains mainly why interest rates change, for example, and finance helps you decide whether to take a loan or not. They are different, but they are like siblings, we could say, so they are constantly interact and influence each other. So, as I said, finance refers to the monetary resources and to the study and discipline of money, currencies, assets, and liabilities. Based on the scope of financial activities in financial systems, discipline can be divided into personal finance, corporate finance, and public finance. Economics. Economics is studying how society resolves the problem of scarcity, which I mentioned earlier. Individuals and society should decide between different alternatives in order to increase their benefits, and it's something that we face every day. individual approach is studied and analyzed by macroeconomics, while the society by the macroeconomics. What are key components of finance and economics? So, the key terms that we deal with in economics are such as opportunity cost, scarcity, production possibility, frontiers, comparative advantages. Sorry. And on the other hand, the finance ones are liquidity, cash flow, costs, and benefit. So about the opportunity cost, is actually when you choose A and you give up B. For example, time spent watching Netflix is time not spent studying. About the term of scarcity, we could say that we always want more than we can have. For example, time, money, even attention. Production possibility frontiers. This shows us the limits of what we can produce when resources are stretched. Comparative advantage. Some people or countries can produce certain things cheaper or better, so this is why trade exists, basically. And these are not just theories, they affect everything from career choices to what a country exports. So we said that the key terms in finance were liquidity, cash flow, costs, and benefit analysis. So this is on the finance side, and we could say that liquidity in this case is how fast can you turn something into cash. And we could say that our smartphone that we use every day is less liquid than the cash in our pocket. Cash flow, you could think of this as the heartbeat of a business or household. So if more money goes out than comes in, trouble is ahead. Cost and benefit analysis, it's basically about should I buy this car or that one, should I rent or buy a certain apartment or house. This concept helps us weigh pros and cons logically and not based on the emotions side. So the key elements which I mentioned. So liquidity refers to an ease which an asset or security can be converted into ready cash without affecting its market price. Example, cash is the most liquid of the assets, while tangible assets are less liquid. Cash flow is a movement of money in and out of a company over a certain period of time. Public companies must report their cash flows on their financial statements. So the other one and the last one, we have the costs and benefits, which is based on the theory of rational choice or rational expectations. Rational behavior means that people try to maximize benefits compared to costs. The key elements of economics, we said that are opportunity cost, which is the foregone benefit that would have been derived from an option other than the one that was chosen. Scarcity, due to this challenge, people in these days that we live are urged to analyze and have the rational behavior. Production possibility frontier is a different combination of output of two goods that can be produced using available resources and technology. And lastly, from the key elements of economics, we have comparative advantages, which is, and it means basically that an individual or a country can produce a good at a lower cost than other individuals or countries at a lower cost. What are the benefits of understanding economics? Um, so, one of the benefits is about choices, because economics teaches us what to choose, because we can't have everything we want, and that every choice involves a cost, which is called in economics opportunity cost. Another benefit is information. Economics provides a method, or would say benefit cost analysis, that helps organize information for better decision making. And sorry for that. So, economics trains us to think in trade offs. It teaches that every decision has a cost, even if it's not obvious. It also gives us decision making tools. Should I switch jobs? Should the government raise taxes? And instead of relying on gut feelings, instead of that, we could analyze data, incentives, and expected outcomes. So we could say that shortly that that's real power from understanding economics. What are the benefits of understanding finance, on the other hand? So, some of the benefits would be practical application, information, and analytical tool. About the practical application, we could say that is the application of the concept of spending, saving, investing, risk management, and money and credit management as well. About the information, we could say that economics provides a method of benefit cost analysis that helps organize information for better decision making. And as a analytical tool, it also involves people to make informed decisions about financial planning and managing money. So, shortly, we could say that finance gives you practical power. It teaches you how to invest, save, budget, and plan for the future, and also avoid falling into debt traps. It's about knowing how credit cards work, understanding why your mortgage rate matters, or how to plan for retirement. So, without these finance skills, life gets stressful. And so, with them, with knowing how to use these skills, you feel more in control of your life and your finances in general. Knowledge of personal finance. When we talk about the importance of this aspect, we could say that it's essential in making well informed personal finance decisions, which is supply and demand analysis. If people understand markets, they can make better decisions about purchasing, planning careers, and making credit purchases. They can answer questions such as why do housing prices differ dramatically in different parts of the country? Some of the other questions could be that why are some industries and careers fading away, and what does that imply for my future? Have I insulated myself from changes in the labor market? Why are credit card rates so much higher than mortgage rates? And the last question that could be potentially asked by someone is that what do the higher rates tell me about the use of credit cards? Knowledge of national finance. We could say that it is impossible to understand the present or plan for the future without an understanding of how our national economy works, which is based on the rules of macroeconomics. They can answer questions such as how will a looming recession affect my employment outlook? How will actions of the European Bank affect interest rates and therefore the cost of borrowing money to buy a house or a car? Another questions could be that the actions of the European Bank affect interest rates and therefore how will inflation affect the purchasing power of my paycheck? How will deflation affect the value of my mortgage payments? Let's continue further to the next slide. So, when we talk about the key elements of economics and finance, we could mention supply and demand, market system, which is affected obviously by the supply and demand. So we could say about the supply and demand that these are the golden rules of the market. So if prices go up, fewer people want to buy. If prices go down, more people do. That's why when a new iPhone is released, it starts expensive. Over time, as supply increases or demand falls, the price drops. So we say that even every marketplace, from groceries to jobs, runs on supply and demand, and that's where we understand how important they are. The law of supply and demand combines two fundamental economic principles. It describes how changes in the price of a resource, commodity, or product affect its supply and demand. Supply rises while demand declines as the price increases, as in the example of the iPhone I mentioned. Supply constricts while demand grows as the price drops, because people want to request buying that product more. So, thank you for your attention. This was about the finance and economics in the overall description of them. So when we wrap it up as a subject, we could say that economics explains why we make decisions, and finance helps us act on those decisions wisely. So together, they help us navigate everyday challenges, from buying groceries to managing governments. They are not just for experts, but they are for everyone. So thank you so much for your attention, and I hope you feel more confident about how finance and economics shape our world and our lives. And I hope the slides will help you understand better and to make the most out of these concepts, which were finance and economics. Thank you. So, in the topic of finance and economics, let's take a real life example, which is an extended example of our presentation's topic. So the example is buying your first apartment, a real life finance and economics scenario. Let's imagine a very relatable situation. For example, you're a young professional who just landed a steady job in a mid-sized European city, let's say Ljubljana or Bratislava, and you're starting to think about buying your first apartment. On the surface, this sounds like a personal decision, but when we dive deeper, this is actually a perfect case to explore how finance and economics work together in everyday life. Since this involves not just your own income and spending, but broader factors like market prices, interest rates, housing supply, inflation, and even employment trends. So let's start with the finance side. You begin with some basic calculations. How much savings do you have? This is what we call liquidity that we just explained in our presentation. Which is our ability to assess cash quickly and easily. Cash in the bank is highly liquid. Investments like stocks or even your car, by contrast, are less liquid. So let's say you have 20,000 euros in savings. Then comes cash flow, the money coming in and going out each month. You earn 2,500 euros per month, pay 800 euros for rent, 300 euros for utilities, groceries, and insurance, and try to save about 400 euros per month. If you want to buy an apartment, your mortgage might be around 900 euros to 1,000 euros per month. Can you handle that? And what if interest rates rise? Now you start thinking in terms of cost benefit analysis. Buying means you're building equity in a property instead of paying rent to someone else. That's a long term benefit, but it also means taking on debt and responsibility for repairs, taxes, and fluctuating interest rates. And those are what we call costs. This is where the economic concept of opportunity cost comes in. By putting 20,000 euros down on an apartment, what are you giving up? Maybe you won't be able to invest that money in a business idea, travel, or pursue further studies. Every decision has a trade off, and understanding these trade offs is key to both economics and finance. Zooming out to economics, let's talk about scarcity and supply and demand. Housing in your chosen city is limited and demand is rising, especially in safe neighborhoods or near the city center. As demand goes up and supply remains limited, prices rise. This is the law of supply and demand in action, and because of that, your decision isn't made in a vacuum. It's shaped by macroeconomic factors. If the country is experiencing inflation, the cost of construction materials rises, developers build fewer homes, and existing housing becomes more expensive. This affects your timing. If you wait a year, prices may rise further and your savings might buy you less. There's also the production possibility frontier, or PPF, as we call it shortly, which shows us the trade-offs in resource allocation. In this context, if the city invests more in commercial real estate, like shopping centers, it might build fewer affordable apartments. Or if your household invests more in owning property, it might invest less in education, health, or travel. These are resource allocation decisions at both a personal and societal level. And finally, let's talk comparative advantage. Maybe you're in a growing field like IT or renewable energy. Your job gives you a stable income and potential for career growth. A comparative advantage compared to someone working in a more volatile sector like retail. Because of this, you may qualify for better mortgage. So, considering that you're considered for a better mortgage or financing options, this gives you a long-term edge in wealth accumulation. And all of these choices and their consequences tie together the personal finance decisions that you make with broader economic forces. So, what seems like a simple life event, such as buying a flat, is actually a dense web of financial planning and economic understanding. It's an everyday example that shows how finance helps you manage resources wisely, while economics, on the other hand, helps you see the bigger picture. So, whatever your choices are, those are the choices that interact with the world around you. Thank you.